The loudest sell calls on gold came from desks that have never owned it. Through the whole long slide, the big Wall Street trading houses sent out their notes. Take profits. The run is finished. Rotate back into paper. And the financial channels read those notes on air as if they were carved in stone. Then the metal turned around and tore straight back through the level that brought you here, one of its strongest runs in months, while the ink on those sell calls was still drying. If you hold gold in your retirement account, or if you sold some of it because a confident voice on a financial channel told you the top was in, this next stretch matters to you personally. So let me give you the honest read right up front. Yes, gold ripped back through the big level in the title. No, it has not reclaimed the record it set earlier in the year, and I am not going to pretend otherwise. But in my years in the gold and silver world, I have learned that the story underneath a move matters more than the move itself. And the story underneath this one is simple. The people who told you to sell hold almost none of the thing they told you to sell. Once you understand that, you will never hear a sell call the same way again. Start with a number that never makes the evening segments. For every $100 the giant institutional portfolios of this country manage, the pension funds, the endowments, the big balanced funds run out of Manhattan towers, something on the order of a single dollar, and often less, sits in gold. That is a historically tiny share. For most of the past century, serious money simply carried a real allocation to gold or gold-related holdings as a matter of course, the way a ship carries lifeboats. That practice quietly died over the last few decades, and the men writing the sell notes came up in the era after it died. They have never owned the metal, never modeled it, never needed it. Keep that single dollar out of 100 in your mind, because later I am going to show you what happens to the price of something small when that dial starts turning. It has turned before, and what followed is something most people alive have never watched happen. I want to tell you about a retired airline mechanic from Wichita, Kansas. He spent his working life in the air capital, on the flight line, and in the hangars of a town that builds airplanes for the whole world. Torque wrench in hand, inspection card on the clipboard, his signature on the line that says an airframe is safe to fly. A trade like that beats one habit into a man so deep it never leaves. Never trust the paperwork over the part. A law book can swear a component is airworthy. The only way to actually know is to put your hands on the metal. When the slide got ugly and the sell calls got loud, he came very close to selling the gold position in his IRA. The voices sounded so certain, so credentialed, so unanimous. What stopped him was the habit. He asked himself the question he had asked 10,000 times in a hangar. Who signed this? And did they ever actually inspect the thing they signed off on? That question deserves a straight answer, so follow the money with me for a minute. A trading desk earns its living from movement, from you buying, selling, switching, churning. A frightened holder dumping metal into a dip is a paying customer twice, once on the way out, and again on the way back in when the story changes. And notice what a sell call costs the desk that publishes it. Nothing. They hold no meaningful gold position, so being wrong about gold costs them not $1 of their own. The financial media runs the notes because certainty and fear hold an audience through the commercial break. That is not research. That is marketing. And the retiree in Wichita, the one with a lifetime of savings actually on the line, is the only person in the whole chain who pays real money when the call is wrong. They have been wrong before, and wrong in exactly this pattern. In the 70s, gold came off the fixed price of $35 and climbed for years, and then, mid-bull, it collapsed. It nearly halved, falling to around $100 by 1976, and the respectable voices declared the whole episode a fever that had broken. Anyone who listened and sold watched the metal turn around and multiply roughly eightfold from that low, reaching over $800 by January of 1980. The people who sold at the low did not sell because the facts changed. They sold because the men with the microphones sounded certain, and the men with the microphones had no position and paid no price. And that is not even the clearest case of big official money selling at precisely the wrong moment. The clearest one has a name attached. In 1999, the British government announced in advance that it would sell roughly half of its national gold reserves, and then sold them at what turned out to be the generational bottom. The market even named the low after the man who ordered it. From that neighborhood, around $250, gold climbed through the entire following decade toward 1900, while mainstream advisors spent those same years telling ordinary savers the metal was a relic not worth holding. An entire stealth bull market ran for 10 years against the advice of the people paid to give advice. If you remember only one pattern from this video, make it that one. Large official sellers and loud media sellers have marked the great bottoms, not the great tops. Now, hold that pattern up against what the most informed money on earth is doing at this very moment. Central banks, the institutions that print the currencies your savings are denominated in, have been buying gold at a record clip for several years running, at roughly double the pace of the decade before. The buying accelerated sharply after 2022, when one major nation's foreign reserves were frozen overnight, and every finance ministry on the planet learned that a reserve held in someone else's ledger is a reserve that can vanish by decree. The European Central Bank itself has reported that gold has now passed the euro to become the second largest reserve asset in the world, behind only the dollar. Sit with that. The issuers of money are converting their own reserves into the metal, while the desks that manage your neighbor's pension keep about $1 per hundred in it and publish notes telling you to sell yours. Here is where the story turns from interesting to genuinely startling, so stay with me. The gold market is small. Not small in headlines, small in actual available metal. The entire world's annual mine production is a rounding error next to the pools of institutional money we are talking about. And most of the gold ever mined sits locked away in vaults and jewelry and central bank reserves that are not for sale at any nearby price. Institutional portfolios, taken together, are measured in the tens of trillions of dollars. Run the thought experiment the sell side never runs in public. If the big allocators moved from that single dollar per hundred to merely a few, not a panic, not a mania, just a partial return to what was once considered ordinary prudence, the buying required would overwhelm years of the world's entire mine supply. There is no warehouse where that metal is waiting. The only way the market could supply it is price, moving up until enough existing holders are persuaded to let go. That is what it means when I say the flows would dwarf the market. The sell calls are coming from the one corner of finance that has not done this arithmetic on itself. And gold is not even the tightest room in the building. Silver has been the leader of this whole advance, and silver finally did something it had failed to do for half a century. It broke above the ceiling that turned it back in 1980 and again in 2011, and it has pushed on into the mid-60s. Even now, its 1980 peak, measured in current dollars, stands a three-figure price above anything yet reached. The old high, honestly adjusted, remains far overhead. Gold is hoarded, but silver gets used up, dispersed into electronics and solar panels and 1,000 industrial applications in quantities too small to ever recover. Most of it does not even come from silver mines. It arrives as a byproduct of copper, zinc, and lead operations, which means higher silver prices cannot simply summon more supply. When the metal that gets consumed starts outrunning the metal that gets saved, that is the market itself telling you something the notes will not. Now think about what all of this means for a retiree who is not positioned at all, and just as importantly, for one who is overexposed. If those institutional flows ever arrive, the repricing will not wait politely for the pension boards to finish their quarterly meetings, and it certainly will not wait for you. But the same force works in reverse on the way through every scare. Shakeouts along the road are violent, and a retiree who owns too much, or owns it in a form he does not understand, can be frightened out at exactly the wrong moment, just like the sellers of 1976. Protection is not about being all in or all out. It is about a portion, held calmly, in a form nobody can talk you out of. That word, portion, is why I bring up the piece of this that worries me most. For years running, the world has consumed more silver than its mines produce, and the difference has been drawn quietly out of above-ground stockpiles that nobody is refilling. The gap does not care about sell notes. It just keeps draining the shelf. That is exactly why our family put together the free Retirement Wealth Protection Guide, because this is not just for insiders. If you have $100,000 or more in any retirement account, a 401k, or an IRA, the guide walks you through how American retirees diversify a portion of what they have built into physical gold and silver inside the account they already have, without taxes or penalties, using a self-directed precious metals IRA. It is written in plain English, from our family to yours. No obligation, nothing to buy. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to readfamilyguide.com. Now let me show you the part of this story the sell notes never mention at all. Look at the backdrop the metal is climbing against, because it tells you how much conviction is underneath this move. The Federal Reserve is divided in a way we have not seen in years. Chair Kevin Warsh holding rates steady, while dissenting members of his own committee argue for pushing them higher over inflation concerns. Warsh has even stopped publishing his own forecast in the Fed's projections, a break from every chair in recent memory, and markets are still learning how to read him. Traders are jumpy heading into each inflation report, bracing for a number that could revive the fear of higher rates. And gold rallied through all of it. A market that climbs while the news argues against it is a market being carried by buyers who are not reading the news for permission, and we already know who those buyers are. Now, let me be straight with you about what I do not know, because you should not trust anyone in this business who skips this part. Gold sits below the record it set earlier in the year, and it may chop around, retest lower levels, and test your patience before that record is challenged again. A hot inflation print could bring the rate scare right back, and history says that hurts. In 2013, a Fed chairman merely hinting at tightening knocked gold down by more than a quarter. A brutal fall that, as it turned out, came near a major low, but nobody holding through it felt lucky at the time. I cannot tell you the day the institutional dial turns, and I will not insult you by pretending I can. What I am giving you is a case built on ownership, arithmetic, and precedent, not a guarantee, and not personal financial advice. But here is the precedent that should keep the sell note writers awake, because it is the closest thing history offers to their own strategy, tried at national scale. Through the 60s, 8 Western nations ran what was called the London Gold Pool, an agreement to sell official gold into every rally, deliberately, to hold the price down and defend the currency system. The most powerful governments on earth, selling into strength over and over. It worked right up until it did not. The vaults drained, one founding member pulled out, and in 1968 the pool collapsed almost overnight, because you can talk a price down for years, but you cannot conjure the metal you are selling. Every institutional seller since has been running a smaller version of the same experiment, and it always ends the same way. The selling stops when the metal runs short, and then the price goes looking for the truth. One more detail from the government's own paperwork, since paperwork is the theme of this video. To this day, the United States Treasury carries its gold on the books at roughly $42 an ounce, a statutory valuation frozen since the early 70s, sitting in the official accounts like a fossil. Meanwhile, the interest on the national debt has grown past the entire defense budget. The country now pays more to service what it owes than to field its military. That is the fiscal ground under the dollar your retirement is measured in. The central banks buying metal by the vault can read those books as well as you can. The desks writing sell notes are paid not to look. The mechanic in Wichita never needed the Treasury's books to understand this. He learned it on the flight line, where the most dangerous corrosion is the kind that starts under the paint. The skin looks clean, the logbook says airworthy, and the structure underneath is quietly thinning year after year. That is what has been happening to the purchasing power of every dollar he saved across a working lifetime, under paint jobs called official statistics. So when the sell calls came, he did what he was trained to do. He ignored the signature of men who had never inspected the part, kept the portion of metal he holds in his IRA, and went back to his coffee. Trust the metal, not the paperwork. He would tell you it took him 40 years around airplanes to learn how much that rule is worth. And understand what happens when the big money finally agrees with him, because this is the part that decides who does well. Committees move last. There will come a day when a pension board can approve a gold allocation without a single raised eyebrow in the room. When the same desks that wrote the sell notes publish glossy research on the strategic case for metal. Some of those banks have already begun quietly raising their gold targets, with calls north of 5,000 now circulating, even as their portfolios still hold next to none of it. When that day arrives, the repricing will already be behind you, because the institutions will be buying their allocation from whoever positioned before they did. You will not read about the turn until it has happened. The advantage you hold over a pension fund is that you answer to no committee. You can act on your own signature, and the man from Wichita can tell you exactly how much a signature is worth when the person signing has actually checked the metal. So think like an inspector about your own position. Size the portion so that no shakeout, however violent, can ever force you to sell what you intended to keep. A holding you can sit on calmly through a bad year is worth more than a big one that breaks your nerve. Hold the real thing, not a paper promise. The exchanges carry far more claims on metal than deliverable ounces behind them, and a claim is exactly the kind of paperwork this whole video has warned you about. And never, ever sell into the bottom of a scare manufactured by people with nothing on the line. Those are principles, not prescriptions, but they are the principles the sellers of 1976 wish someone had handed them. Before I let you go, think about what all of this is actually for. It is not just the number on your statement. It is the house your kids grew up in, the help you want to give your grandchildren, the independence you promised yourself after decades of showing up. That is why the free Retirement Wealth Protection Guide is built around legacy, protecting what you spent a lifetime building and passing it on intact by diversifying the portion into physical gold and silver inside the retirement account you already have, without taxes or penalties. And if you have $100,000 or more in your accounts and you have watched this far, mention that you watched the full video and our family will set up a free one-on-one educational web conference. A real conversation. Your questions answered. No obligation, nothing to buy. From our family to yours. As for why now, the honest answer is that the easiest time to inspect the airframe is while it is still in the hangar. Nothing about this moment forces your hand, and that is precisely what makes it the right moment to look. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to readfamilyguide.com. They told you to sell. They told the mechanic in Wichita to sell. They told the sellers of 1976 and the British Treasury the very same thing, and the metal tore through anyway. Torn through by buyers who own vaults, not notes. Somewhere in a hangar in Wichita, there is a rule written in 40 years of grease and signatures, and it fits your retirement as well as it ever fit an airframe. When the logbook and the metal disagree, the metal is telling the truth.